Okay, so now tell us the story of Astra, because I think the thing that stood out to me at MIF was the sweat equity component of what you guys did to get the deal done. But I don't want to take away from it, so I'll let you.
Yeah. Yeah. So Astra, I guess I'll just start by going back to the beginning. Astra is a company that I co-founded in 2020 with several of the people who are currently involved. I'm a big believer that people are the most important part of the equation, and you'll hear that argument all the time. It's the people, no, it's the geology, no, it's capital structure, and at the end of the day, the people are what make all of those things happen. They, structure the company right or wrong. They get you in the right rocks or the wrong rocks. They're trustworthy or they're not. And so the company was built basically, as hand select individuals um, who I thought were the best for the task at hand. And if there was any silver lining of COVID, it was that I wasn't geographically constrained to sourcing talent from one location. I could go anywhere in the world and just find the best people for the job. So that was what the company was predicated on. And so that was in 2020. Um, we, did a few years of work. We had two projects in the portfolio. Um, Market conditions were less than optimal, to put it lightly. They continued to deteriorate for juniors. And in 2023, we had done some drilling on one of our projects in Chile, and we got some decent results, but no value in the market for it. So we were faced with a decision. Was that to either try to raise the money that we needed for the next drill program in Chile, which would have been about $4 to $5 million, or we could tuck our horns in and go shopping. One of the things that we had at that time, like I said, we built the company from the ground up. The capital structure was with intent and by design. And I knew that we had a tremendous amount of value in our capital structure. And one of these things, as you mentioned, Michael Gentile is our largest shareholder. He's a very active name in the space. Uh, but he invested with us on our first public financing in 2022. And even though he knew that Astra, as well as many other companies in his portfolio, were struggling, and one thing that stood out to me was that every time an idea came across Michael Gentile's desk that he potentially liked and they were looking for a home for it, he always thought of Astra because of our pristine share structure. And
Hmm.
so when I was talking to the team, I was really trying to emphasize the value of our capital structure, and that if we could maintain that and get through this downturn and perhaps even add in a high quality asset, as Warren Buffett says, it's you be fearful when people are greedy and greedy when people are fearful. So when everybody else was running for the exits, I told the team, I said, let's go shopping and try to find the highest quality asset we can. And so I took it to Diego. Guido is our head of exploration, and I said, look, the decision's made. We're going to find another asset. I said, find me something that's got high grade, multi-million ounce potential and is anchored by an existing resource. And he literally laughed at my face. I mean, vis-a-vis on screen, but he literally laughed at me. He says, you want me to find a unicorn? I said, yeah, I do. You're the man. You've seen Latin America. I said, go get it. And we're focused in Chile at the time. And he pauses for a second and he says, can I look in Argentina? I said, depends on province. He says, Santa Cruz. I said, yeah, we can look in Santa Cruz. And then without missing a breath, he goes, I know the project that we need. It's called La Manchuria. He said he was on it 20 years ago as a junior geologist. It stood out as one of the most exceptional projects he's been on, and he's been on a lot all over the world. He said, this is the project for this company. Of anywhere that I know, this is it. I said, okay, well, that was easy. And he says, no, he says, I've tried to do deals on it, over the years. And this company that owns it, they don't sell anything. They're acquirers. They've got the largest land position in
Interesting.
the Casiota Massif. Um, so I said, well, okay. I mean, you did your part here in about 30 seconds. So um, I'll do mine. And it took 13 months. We negotiated, and it took 13 months to put the deal together. But we did get a deal signed. We got it brought in, got an option agreement on it last year. We took this to Michael Gentile, and we said, look, we know we've been quiet for several months now, but look what we found. We got a deal on this. And he and Simon were on the call, and they couldn't believe it. They're going, this is amazing. And so it's got these super high grades that were drilled at a shallow depth. Um, but the previous focus was different than what ours is. We're looking for high grades. We're looking for the roots of this thing.
Yeah.
And so one of Michael's questions, he said, okay, well, how much are we going to need to finance to do an initial proof of concept program? And I told him, I said, we can do it for $2 million. And he says, well, the company's been on fumes for a while. How much debt have you got accrued?
Yeah.
And he said, well, how you been paying yourselves? I said, we haven't. We worked for free for a year. So I didn't even tell Michael Gentili this until after he decided to invest in it. But he was floored that it wasn't deferred pay. It was we'd work for free. We firmly believed if we could get this in the company that we were going to be in a very special spot. So that was La Manchuria. We did the first drill program on it in earlier this year in April, May, and we had some very good results. We gave Diego basically $1.3 million for a drill program. And at our peak price here in the last couple of months, it was over $70 million in market cap that he'd created with that program. So,
Wow.
yeah, it was.
Looking at it like
a little more than 2 minutes, but it really did kind of turn into a Cinderella story at this point.
But that's the thing that's fantastic is like first of all, like your company, you were a founder in, you started it, you kept the structure clean, you prioritized the capital structure over raising money to pay yourself, which that's hard to do, at the end of the day.
I can't even think how hard it is to do.
Yeah, there's a lot of details probably of the day-to-day that you had to figure out because you didn't have that as an option. And so very, very, very interesting story there. And I like how you guys didn't accrue your salaries or accrue pay. What's the reason behind that?
Well, at the end of the day, it's, we were trading below 10 cents. So we were 5 to 10 cents at that time. And if you raise money, first of all, I'm honest when people ask, I say, what are you raising the money for?
Yeah.
I tell them working capital. And I say, oh, so writing paychecks and keeping the lights on. Nobody wants to do that unless there's a clear path to something greater. And at that time when we were shopping, not even shopping, we'd identified the project, but there was no certainty. There was no certainty we were going to get it. And 13 months, that's a long time to be working on something. So time is risk. And if you accrue pay during that time, you then have a liability on your balance sheet. So then you go back to investors and they say, okay, how much do you need? X amount. And the first thing that they see is, there's whether it's 200,000 or 400,000, whatever the number, I've seen it upwards of $1 million. What's the first thing that, we need to pay ourselves back pay. No investor wants to pay your back salary. So it's a turnoff on every front. And it's specifically the reason that I designed the company and the share structure as I did. Management co-founders were participating in every single financing from the get-go. So you want to be as perfectly aligned with your shareholders as possible. And when you think about it, if somebody comes to you and says, hey, we need some investment money, so what are you going to do with it? Well, a big chunk of that's going to go right into our pockets. Who wants to invest in that? Nobody does. You got to put yourself in the investor's shoes.
Yeah. No, there's no appeal to that. There's no value creation in that right. Capital. Yeah. Very interesting. So you're taking an investor first approach on that. That's the reasoning behind it. I am curious, like one of the key stats that we found popped out to us is that if you look at U.S. public listings, like since the mid-90s, IPOs have slowed down. It's down about 50% since the mid-90s. And then in 2024, there was only 150 IPOs that were over $50 million. And then there was 397 in 2021. So you are a U.S. company, right? Or you are a U.S. individual. Why did you have to go up to Canada to set up a U.S. or a Canadian company and go public on the Canadian exchange to raise capital? Why is there no option in the States?
At the end of the day, well, there is. You can do an OTC listing in the States, which we have. I mean, that's an option. But the liquidity on it is, it's not even comparable. As you mentioned earlier, by comparison, the U.S. doesn't even have a junior market. And several reasons for that, I think. One is that private equity's taken a big chunk out of what used to be IPOs. It's become an alternative investment source. And to some degree, that is attractive because, and believe me, I've thought about that before. There was at one point, it had nearly sworn off a public listing until you reached a certain status. And that's because the regulatory and compliance cost with a public listing is oftentimes cost prohibitive to a very small microcap company.
Mm.
And so there's, it's a double-edged sword. On one front, you have the market provides liquidity on the
Mm-hmm.
exchange, and that can also be used for good and bad purposes as well. You get
Mm-hmm.
founders that have loaded their pockets with founder shares that want to IPO, and the first thing they do is dump their shares on the market because that's a
Mm-hmm.
liquidity event. So you got to be careful of, if you're going to be a privately held company, and you're going to invest in private companies, as an investor, you better be sure of who you're investing with because you're going to be with them for the long haul. There's no exit for you as an investor, or at least not the option. So I think to your question of why does Canada have a market, so to speak, and the U.S. does not, I think that probably comes down to, if you look at the makeup of the respective economies, Canada versus U.S., I
Mm-hmm.
think mining in Canada is roughly, oh gosh, I don't know. I think it's around 5% of the economy, and it employs, depending on where you get facts from, close to 1 million people in Canada.
Yeah. Only in
So
Vancouver, we have 1,500 publicly listed mining companies.
yeah, yeah,
Like
it is.
over 60% of our public markets are mining companies or like resource
Yeah,
sector.
it's a much larger percentage of the GDP in Canada than what it is in the U.S., both in nominal and relative terms. And
Okay.
so I think that that's why you tend to see the Canada-centric focus for listings. And to be perfectly honest, it's not a far journey. There are
Yeah.
some onerous compliance issues between U.S. and Canada, but as far as U.S. making investments into Canada, but otherwise, there's just nothing that's even close to second place here in the U.S.
No, and it's interesting because like even if you look at the legal reasons, like U.S. has some stuff related to like prohibiting of penny stocks, and so they have minimum like $1 share price requirements, but they don't actually care about the market cap as long as you're at a $1 share price, which I find a little bit ridiculous because market cap's actually what matters,
Makes no
right?
sense.
It makes no sense, and so it's like deliberately turning people away. Then you have private equity who is buying up all these opportunities, privately. But I do think we're kind of seeing a phase. Like there's all these, specifically in tech, there's been all these years of massive venture capital investment. Now there are a lot of companies, I know a lot of companies personally, that are probably doing between 10 to 100 million a year in revenue. They don't have any wedge in the market that would make them a massive player like an Amazon or a Google, but they do have enough of a wedge where they can continue to generate revenue and build cash flow. But they don't want to go the private equity route because then they feel like they lose all control. And since 2021, we've now got this new opportunity in the retail investors that didn't exist before, like Robinhood, in Canada, Wealthsimple. Then there's E-Trade, Schwab, Vanguard. All these guys put out their own trading platforms. Most of retail money is now self-managed, not managed by brokers. And so now there's an opportunity for entrepreneurs to interact directly with these investors, which could be interesting to see how that pans out over the next 5 to 10 years. But again, without like a vibrant, or supporting regulations in the U.S., it's going to be hard for companies. Like there's a lot of people that could have taken advantage of Astra, if there wasn't that $1 share price requirement, if
Yep.
there was more, or like another thing too is the accounting laws are very, very strenuous on the larger exchanges. So then it makes it expensive for the smaller companies to even list there. That's another big hurdle. And I think, maybe AI and some of these other tools can help over time reduce those costs by automating a lot of the things that people do. But it's interesting to think about the sheer number of companies that the public could have access to if they were more flexible with regulation, or not even flexible, but more friendly with people who are earlier stage. Because right now it's kind of like a club. You're in the cool club if you can access these deals in the US through private equity or VCs or funds. when it could be the way it is in mining, where you could buy Astra, anybody could buy Astra, and as you guys are producing value, like the 250% you've already done in year to date, people could benefit, right? But it's been something that's stuck on my mind where I'm wondering, what do you think would have to change? Would it have to be a difference in, like, let's say regulation aside, do you think that retail investors would take up positions in companies like yourself, or do you think that your company is better fit for large institutions and large funds only?
Great question, because what you just mentioned there is um, it's almost like we're a no fit for any demographic really. When you just say
Mm-hmm.
on the retail side, so to be perfectly clear,
Mm-hmm.
early stage exploration like Astra and earlier are extremely high risk,
Mm-hmm.
and you know just because number one, you don't know if you're going to hit something that's going to be of value or not. But number two, the business model, you're not creating any revenue. So every bit of money that you have to raise is dilutive. And at
Mm-hmm.
a small market cap, it's extraordinarily dilutive. And that's the greatest risk. So as the regulators would say, we're too high risk for the average retail investor. But yet, on the same hand, go out and buy a lotto ticket, and they don't have a problem with that.
Yeah, that,
So
exactly. Like that's a total contradiction.
yes, I agree. But then on the other hand, you get the institutions and the funds, and they won't even look at you until you have a $100 million market cap. So we're kind of stuck in this. If you're below $100 million, the institutions won't look at you because it's just part of their mandate, part of their charter. They absolutely will not break it. And then, you're too small for them, but you're too risky for a retail investment. So yeah, it's I don't know. It creates quite the conundrum. But as far as on the regulatory front, when you said they could be more accommodating or more friendly, I think you said is what you
Yeah.
put it. I think the big thing there has more to do with being more consistent as
Okay.
far as a regulatory regime. So being consistent in the rules and being consistent in the enforcement of the rules. And
Mm-hmm.
one thing that is it's a conflict of interest is that you have close to 2,000 junior companies listed on an exchange, and many of them, to be perfectly honest, have no business being a listed junior exploration company,
Mm-hmm.
and um, that makes the entire pool of companies more toxic, if you will. There's more landmines to step
Interesting.
on for an incoming investor.
And
If
why are some of them, why would they have no business being on there? What differentiates that?
To be perfectly honest, there are companies who do not know what they're doing, and they take advantage of bubble market opportunities where you could be selling lampshades on Tuesday and turn yourself into an exploration company and be able to raise millions of dollars on Wednesday. And
Yeah.
they take advantage of that. That's one. So bad actors. And
Mm-hmm.
number two, people who just outright are frauds. They game the system. They raise money and they pay themselves fat salary and they never make value,
Mm-hmm.
but they're able to reinvent themselves. They roll a share structure back, change a company name, and lather, rinse, repeat over the years. The conflict of interest comes from being listed. The exchange collects listing fees from these companies. So
Mm.
oftentimes, especially in downturns, to delist companies means to cut your revenue stream. And who wants to cut their revenue stream? It's an inherent
That's
conflict.
interesting. I've never thought about that.
It's an inherent conflict of
Yeah.
interest, and I'm not here to bash on the regulators, the exchanges, or anybody. There's just nothing is a
Hmm.
uh,
Yeah.
perfect environment by far. But I think that there's a lot that could be done to increase the overall quality and health of the industry from a
Yeah.
regulatory perspective, and consistent enforcement is a big one of those. If
Yeah.
you have
Very
the rules
interesting.
set the rules. We'll deal with whatever the rules are, but enforce them consistently. Because the greatest thing that markets, or I guess the greatest detriment to markets is uncertainty. Now,
Mm-hmm.
positive or negative doesn't matter, but it's the uncertainty that kills
Hmm.
Mm-hmm.
markets.
So do you think there could be like a functional junior market in the US if there was less regulatory burdens, but also just more consistency. People could trust it more, less uncertainty.
Yeah, I think the consistency and enforcement, and I think that another thing that would be equally important is to work closely with people who are actively involved in the space as directors, as management, who and they do, don't get me wrong, they do. Um, but the more closely you can work with these professionals who deal with the issues that can and will come up no matter what kind of guidelines you have, to work within to work with groups who are involved directly in that, in the trenches, so to speak, on a day-to-day basis, I think is very important.
Well, to your point about like the bad actors, so in VC worlds, in the venture capital world, that's highly, highly, promotional and very like regarded in a good light. You see it all the time whenever there's a bubble. Founder raises $3 million, buys $2 million house, like, or you see situations, and they're still private. They're still private. Private has even less oversight. So the bad actors is definitely an issue, but it's also like then you don't have the good companies who want to be associated with that, right? So I think, do you think that there's like, what do you think's deterring great companies from going public earlier? Why wouldn't a great company with, a good asset or good cash flow, because there are some private mining assets still, but why wouldn't they go public earlier? Aside from cost, do you think it's related to the optics of how being public is perceived? Do you think it's because it's hard for the right investors to even invest if you're public, so it's not worth the hassle? Where is the friction point for these companies to go public?
Well, I think as far as the smaller scale, I'm talking micro caps, small micro caps. I do think that the biggest hurdle is cost. But when you're private, if you go private equity route, your access to capital is much more limited. There is a lot out there of private equity, but it's much more discreet. There's smaller pockets, smaller pools, and you got to have good contacts. You really got to know the right people, and they've got to know you. Because, like I said, as a private equity investor, if you're going to invest in a private company, you better know who you're investing with, because you're going to. What's the saying? The saying, I think, is if you're going to start dancing with a bear, be prepared to dance until the bear's ready to quit.
I didn't know that. That's a good one.
So yeah, it's so I think that's part of it. And a lot of times when companies when they look to do something public, when they look to do a public offering, they're also looking for liquidity. Generally speaking, you can have control or liquidity, but good luck having both.
Interesting. Do you feel like you have control in the direction of the company in Astra?
I absolutely have influence, for sure.
Yeah.
And it's, I'm at the helm, and fortunately I'm backed by several people who are far smarter than I am in their respective disciplines. But I've got a great support group around me that when I have questions, I can lean on, I can pick them up.
And it's structured in a way. That's the other thing too. I think that's key, is that structure comes into play heavily when you go public. I've always wondered, there's this fund or firm out of San Francisco called Y Combinator. They do 3 batches a year now where they invest in a few hundred companies. They cut $500,000 checks to each company, and most of them don't go anywhere, but a few of them become Stripe, Airbnb, so on, Instacart, so on and so forth. And so I was always wondered, what they did essentially is they standardized the deal terms for raising private money. And when they did that with the SAFE, Simple Agreement for Future Equity, the amount of access to capital for early stage companies exploded just because there was less friction. Anybody could access their documents publicly, sign it, give you a check, you had a deal. The Simple Agreement for Future Equity is essentially a loan that converts to equity at a future date, no maturity date, no expiry. So it means that you don't pay tax on it when you receive it either. So there was a lot of benefits to this agreement, and it was short, 5-6 pages. And so they essentially helped kickstart the fundraising of earlier and earlier stage companies. And I've wondered if there was somebody who did that in the States, but then you run into the problem where there's no exchange that people would go on, right?
Hmm.
If you make it easier, but then there's no exchange, then they still have to come up to Canada. Do you feel like there's been a hindrance for you listing in Canada and having OTC to accessing US money, or no? It's been just as easy to access money all over.
Um, Sorry, say that again.
So do you think that because you're a Canadian company, although you have an OTC listing, you're Canadian listed, has it been harder for you to access American capital?
It is. It's more difficult to access American capital. And I think not necessarily because the interest isn't there. Number one, I don't think that many investors in the US, or as many in the US, are as familiar with the mining and exploration space as what is in Canada. I think
No.
that Canada is just definitely a more sophisticated investor audience for that. And then I would take that one step further. You go to Australia, and I would say that Australia is to Canada what Canada is to US.
Yeah.
And so I do think that that's part of the difficulty.
I also
As
think I think we're also starting to see like more Americans get interested in the mining and metals with this whole critical metals push and the tariffs that Trump is doing. Now they're starting to pay more attention. So you have the interest issue is why American capital might be harder to access is just because, sorry, not interest, but education. They're not as sophisticated in mining. It's not as much on their radar. So that's one issue. And then what were the other ones you were saying?
I can't remember. I was going to say something else. You'd mentioned about an OTC listing, and whatever I was
Yeah.
going to say already left my mind. So
Oh, good.
it might
It's
come back.
probably like requirements to be able to list or to be able to invest. But it's yeah. I think like we'll wrap it up here pretty quick. But what I find super interesting is that if you're an entrepreneur out of the States and you're building a company in the mineral sector, you are currently doing something that the U.S. direly needs. Like the U.S. has this big push right now for critical metals, precious metals, gold, like everything. They're like realizing that, oh, we've been outsourcing everything all this time. Now we don't really have our own pipelines. We don't have our own minerals, even though there are minerals in the U.S. and there are American entrepreneurs like yourself who are in this space. But you guys have to go to other places. And what it makes me wonder is, do you think there's going to be a shift in the next 5 to 10 years to people supporting this more in the U.S., or do you think this is a blimp?
I think that completely depends on how crazy the geopolitical scene gets worldwide. Because you make a great point. I think that people, because mining makes up such a small portion of the economy, so let's just talk on a dollar basis. I think it makes up like 1.5% of the U.S. economy and 4 or 5% of Canada's economy. And so,
Mm-hmm.
because it's such a small percent of the domestic economy, people have treated it like it's not very important. When at the
Mm-hmm.
end of the day, it underpins everything we do,
Yeah.
absolutely everything. And now that geopolitical tensions are on the rise, and you have tariff wars, and you have whatever else you have going on, all of a sudden people are going, "Where are we going to get this?" Because we just upset the people that we used to buy it from. Uh,
Yeah.
Case in point, copper underpins everything. I think Chile accounts for close to 20% of global copper production, and 60% of the copper that the U.S. imports is from Chile.
Wow.
Mhm.
So
Wow.
you start talking and you start looking at the reality of the situation. I think that's why I give the answer that it completely depends on how crazy the geopolitical scene gets.
Yeah.
Because that's what's going to influence if people want to get educated.
Yeah. It's not like suddenly it's so much more important. It's just the
It's
political environment is making people realize
yeah.
things.
It no, that's exactly right. It's always been important. It's just that
Yeah.
people didn't realize how important it is, and it's going to hit them in their wallets first and foremost. And maybe even worse as far as what can what kind of infrastructure can or cannot build or cannot upkeep because you don't
So,
have access to the metals and minerals.
So that's another interesting point. Like, I mean, there was recently a podcast with Sam Altman and the CEO of Microsoft, and they were having a conversation, and the CEO of Microsoft said, we have NVIDIA GPUs sitting on the shelf. The issue is not the GPUs, it's the power and it's the space. We don't have enough power and we can't put it anywhere. And so now I think that's really starting to hit people like, oh, our grid just like, because there's this big push for electrification, our grid just can't handle it. We need these metals. And then you brought up a good point, which is they're going to start to realize that the infrastructure is not there. So when you're looking at building Astra, some of the catalysts that you guys have, because mining takes time to build, but there are things in between that can really help it grow quickly, even in terms of value. What are the catalysts that you guys have that are like value creation moments along the process of an exploration company? And this doesn't need to be specific for Astra. I'm just wondering, as a whole, what are the value creation events for an exploration co?
The biggest marginal increase in value is at discovery, bar none. Mm-hmm. So it's like Astra here. So you're a 5 million market cap a year ago, and then you're a 50 to 70 million market cap 10, 12 months later. And then it depends on, okay, so we're a $50 million company, but, you could spend a relatively small amount of money and become a 100, 200, 300, $400 million company. If you've got some good success and you've got something that's scalable. So the discovery is where it's at. And then scalability is where it's at. So those are kind of the major value creation points. And I don't know if you've ever probably heard of the Lassonde Curve, Pierre Lassonde. He's got the Lassonde Curve, which is, generally speaking, it shows the life cycle of a mine from discovery to production, and that peak value happens after discovery, and then when it gets into a development phase, investment leaves because it's kind of a long, boring process where it's not that value's not being created, it's just that you can't really, absolutely.
This orphan period right here.
The orphan period. And it's not that there's not value being created there, it's just not as exciting, and you don't tend to see the marginal value created at that time. So you've got permitting and development and metallurgy and all the analysis that goes along with that. And then investors come back into it when all of that de-risking has taken place, and they say, okay, here's the economics of this thing. Here's what you can expect as a return.
I think being boring is mining's biggest downfall for always.
What's that?
I think just being not exciting and being boring is mining's downfall always. Everyone just doesn't really think about it. They talk about all the tech and the new stuff that's coming out, not realizing that they need mining companies to make it happen.
And that's a great point. And I think that something as an industry we've done very poorly is educate the public on mining, because it's absolutely exciting. And whether that comes in, there is something about seeing visible gold come out of the ground in a place that you've either drilled or, sluice box, done, placer mining. There is something about that is just absolutely fascinating. And that's what hooked me as I went up for a summer in Alaska working on a placer mine, and you could actually see gold come out of the ground. It's spectacular. And, you need to get people involved in an early age because it is cool stuff. And
that feeling of that seeing it come out is just, yeah.
Oh, it's wild. And what's funny is there's actually pictures on the website. We did a thing a while back, Meet the Team, and I completely forgot these were on there. Somebody sent me pictures of myself when I was in Alaska, and I'm going, where did you get these? They're on your website. And so, we did, and this was a couple years back. So under the team profile, there's a Meet the Team. But I'd put pictures on there of me holding some of the gold nuggets from my first mining job in Alaska. And so, if you get people involved in stuff like that, I think it's game changing, because it's incredible. It's a great experience. There's nothing else like it in the world.
And it's something to see, like, especially like when you discover something new when you're going through, and there's like you guys did with your project in Argentina, and then you see the value creation happen. Like that is fascinating. And Now it's a game of how big can it be. So each time you guys do a step out, each time you guys, try a new hole in a new place and you hit that as well, then you get another value creation event, another excitement, because people realize there's even more gold, there's even more silver there than they would have thought. So it's super interesting. And I think to your point, like I've been to site a couple times for a couple different companies, and every time I go to site, that's when I fall in love with the company.
Yeah.
And site visits are something that it's so rare to experience. And it's definitely like, I feel like if there was more of them online, people would fall in love with it. It's so amazing when you go to these mine sites and you see what they're drilling and what they're doing.
Yeah, that's a great point. And to Mariah, to your point that it's boring, you actually go to a site and see what they do. And if you can take a broad tour, like the grand tour of everything, and see the machinery. So, kids grow up and they're like, I like to run big equipment. Well, you don't get much bigger equipment than in a mine, and they need good operators. Someone's like, well, I like computers. Well, let me go show you a 50,000 square foot tent that's all they do. People are like, well, I like hiking. It's like, well, tell you what, be a geophysical or be a geological mapper. Well, you can hike as much as you want. And so you get onto these sites and you go, oh, there's so many things. I don't have to have a mining degree to be in love with mining or work in mining. There's so many people who could and would love mining if they were just introduced to it physically early on.
Yeah.
To clarify, I wasn't saying that it was, but I was saying that it is its problem. Is that the marketing and the IR and everything? I feel like its problem forever has been that it's made it so boring. When it
sorry, not to put words in your mouth.
No.
That's a great point. I think one of the best points, the perception, is that it's boring. I'm glad you raised that.
Yeah, we'll change it. We'll work on it. Brian, thanks so much for coming on. This has been awesome. Really good to connect.
Yeah, very good. Nice to be back with you. And Mariah, very nice to meet you.
Nice to meet you too.